So imagine walking into a final round job interview. You've completely nailed every technical question.
Right, feeling good.
Exactly. Your references are impeccable, your portfolio is flawless, and you walk out just knowing you have the offer in the bag.
The absolute best feeling.
Right. But then a week later, you get this totally generic rejection email. And the reason has absolutely nothing to do with your resume or your skills.
Yeah, they ran a background check.
Exactly. They pulled your credit file and decided that this, three-digit number attached to your name made you too much of a liability to hire.
I mean, it sounds totally dystopian when you frame it that way.
It really does.
But for anyone seeking a role involving like financial oversight or sensitive data or executive decision-making, it is standard operating procedure.
Yeah.
We're looking at a presentation today from Greenbridge Inc., and it completely dissects the mechanics of debt and credit. And the overarching theme of these materials is that a credit score is, well, it's no longer just a metric for bankers to decide if you get a mortgage. It has evolved into this comprehensive financial reputation that basically precedes you in almost every major transaction of your adult life.
Which is exactly why we're doing this deep dive. Because the mission here isn't to, lecture you about your spending habits or preach about the virtues of skipping your morning coffee.
No, nobody wants to hear that.
Exactly. We are diving into the Greenbridge materials to decode the actual plumbing of the credit system. Because once you understand the mechanical rules of how the system evaluates you, it stops being this opaque, terrifying judgment of your character.
Right. It just becomes a game you can learn to play.
Exactly.
And the first rule of that game, according to the presentation, is recognizing the trap of the quick fix.
Yes.
Materials explicitly warn, and I'm quoting here, don't acquire more debt to eradicate your debt. It's a fundamental law of financial physics that institutions really rely on consumers' misunderstanding.
So let's unpack the mechanics of that, because the source material mentions balance transfers as a tactical move, but it also warns against this debt cycle.
Yeah, it's a fine line.
Right, because for an audience that knows the basics, we understand that moving, say, a $10,000 balance from a card with a 20% interest rate to a card with a 0% introductory rate. I mean, that seems like a smart mathematical play.
On paper, sure.
Yeah, you're freezing the interest. So why does Greenbridge classify this as a trap?
Because it creates this balance sheet illusion. When you move that debt, you alter the structure of your liabilities, but you haven't actually changed your cash flow velocity.
Okay.
The mathematical play only works if the underlying behavioral mechanism changes. What the banking algorithms know, and quite literally what they bank on, is that the average consumer will see a zero balance on their original high-interest card and perceive that as newly available purchasing power.
I see. So the total debt volume doesn't just shift, it basically expands to fill the newly available vacuum.
Exactly.
You haven't eradicated anything at all. You've just, opened a second front in the war. You end up with a maxed out original card and a ticking time bomb on the new balance transfer card once that introductory rate expires.
And the underwriting algorithms are highly, highly attuned to this pattern. When they see a sudden shuffling of debt across new revolving accounts without a corresponding decrease in the total principal over time.
They catch on.
Yeah, the system flags it as liquidity stress.
Mm-hmm.
That is exactly how your financial reputation takes a hit. And the materials emphasize that protecting that reputation is paramount.
Yeah, there's a specific chart in the Greenbridge presentation that highlights the 760 to 850 credit score range,
The top tier.
the golden zone. The materials are really clear that sitting in that 760 to 850 bracket dictates not just your interest rates, but housing opportunities, the ability to secure business capital, and, going back to our opening scenario, job opportunities.
Right.
But I actually want to push back a little on the logic of that employment screening.
Okay, let's hear it.
I mean, I understand a bank wanting to know if I'll pay back a loan. But if I am a stellar software engineer, why does an employer care if I'm carrying $20,000 in revolving debt? What does one have to do with the other?
Well, the employer doesn't actually care about the bank's money. They care about behavioral predictability.
Okay.
In risk management, a credit score serves as a proxy for executive function and reliability. The logic that underwriters and risk managers use is that managing personal debt requires long-term planning, impulse control, and the ability to honor commitments over time.
Right.
So if a candidate's financial file shows this really chaotic pattern of missed obligations or maxed out leverage, the risk modeling suggests a higher probability of erratic decision-making under stress in a corporate environment.
Wow.
Yeah, it's not a moral judgment at all. It's purely a statistical risk assessment.
Okay, so if this three-digit number holds the keys to the kingdom, and mismanaging debt can literally cost you your career or your apartment, the logical conclusion for anyone listening would be to just avoid the system entirely.
To walk away.
Right. Just opt out, pay cash, cut up the cards, and never owe anyone a dime.
Yeah, that's the Dave Ramsey approach.
Exactly. But the Greenbridge presentation pivots hard away from that. There is this entire section titled Leverage Debt, Don't Let It Use You. It completely separates debt into good and bad categories.
And this is the paradigm shift that separates standard consumer finance from actual wealth-building strategies. The presentation strips all the emotion out of the word debt and treats it purely as a mathematical tool.
Okay.
Bad debt is defined by the materials as consumptive. It's high-interest borrowing used to fund lifestyle expenses, depreciating assets, or emotional purchases where you just carry a long-term balance.
It extracts capital from your future to pay for your present.
Exactly.
Right, so bad debt is essentially a treadmill. You're running, you're sweating, you're paying this massive premium and interest every single month, and you aren't moving forward an inch.
I love that analogy. Good debt, conversely, is an elevator. The sources define it as productive. It's capital acquired at a low interest rate, specifically to purchase or build assets that will appreciate in value or, increase your earning power. It is highly strategic.
Right.
So if you have the opportunity to borrow money at a 4% interest rate to acquire a piece of real estate or a business asset that generates an 8% annual return, well, you're capturing that 4% spread using someone else's money.
Okay, but let's look at the reality of that leverage. Borrowing at 4% to make 8% sounds like a genius move in a spreadsheet.
Right, theoretically.
But leverage is basically a magnifying glass. If I use a bank's money to buy an asset, and the market turns so that asset drops in value by 20%, I don't just lose my own capital.
Nope.
I still owe the bank their principal plus the 4%. Doesn't good debt just magnify your downside risk to a terrifying degree?
It absolutely does magnify the risk, which is exactly why the system gates access to that kind of leverage behind the 760 credit score requirement.
Ah,
The presentation isn't suggesting that good debt is risk-free. It's suggesting that wealthy individuals use their pristine financial reputations to access capital cheaply enough that the mathematical probability of a positive return outweighs that magnified risk.
right.
The bank demands a 760 score because they need mathematical proof that you have the financial discipline, the cash reserves, and the behavioral stability to weather that 20% market dip without just defaulting on their loan.
And that brings us to the absolute most frustrating catch-22 in the entire Greenbridge document.
The paradox.
Yes. To get the cheap capital to buy the assets, you need the pristine reputation. But the source explicitly points out the paradox. You cannot build a credit history if you have no credit. Lenders need a history of borrowing and repaying.
Yep.
You cannot prove you're good at managing the bank's money until they actually let you manage the bank's money.
It is the ultimate barrier to entry. And to solve it, the presentation outlines specific mechanical rules for establishing that baseline history.
Right.
And while they frame them as rules for beginners, the underlying algorithms apply to anyone trying to optimize their score. They focus really heavily on credit utilization and payment consistency.
So let's talk about that utilization metric, because the materials say to keep utilization low, but they don't really dive into why the algorithm is so obsessed with it.
Right.
I mean, if a bank gives me a $10,000 limit and I spend $9,000 and pay it off on time, shouldn't they be thrilled? I'm using their product exactly as intended. Why does high utilization hurt the score?
Because of how predictive modeling interprets available capital. Think of your total credit limit like the red line on a car's tachometer.
Okay.
The engine might be capable of hitting 7,000 RPMs, but if you drive it there constantly, a mechanic knows that engine is under severe stress and is statistically way more likely to blow a gasket.
That makes sense.
The algorithmic model views credit the exact same way. If you're consistently using 90% of your available limit, the model interprets that as financial stress. It suggests you're reliant on credit to survive, meaning you lack a cash buffer.
Right.
The algorithm rewards low utilization because having $10,000 available but only using $500 proves you have self-control. You don't actually need the money. And banks historically love lending money to people who can mathematically prove they don't need it.
That is so true. The unused limit is the proof of your discipline.
Exactly.
And the Greenbridge materials offer some tactical ways to maintain this, like limiting yourself to just one or two cards and keeping your oldest accounts open even if you do a balance transfer, assuming there's no annual fee.
Right, because closing that old account just deletes the length of your credit history, which the algorithm values highly.
Yeah. But as I was reading through these rules, I hit a massive contradiction in the text.
Oh, which part?
Well, the text insists that lenders demand a documented history of borrowing and repaying. You have to put debt on the cards to generate the data points the algorithm needs, right?
Right.
But then, literally on the very same page, the presentation advises pay with cash or debit instead of credit cards. I mean, how on earth do you execute both strategies? You can't build a credit history while actively avoiding the use of credit in your daily life.
It definitely looks like a contradiction until you look at the behavioral economics behind it.
Okay.
What the source material is attempting to do is separate the mechanical plumbing of the credit score from the psychological friction of spending money.
Interesting.
The mechanism of the algorithm absolutely requires consistent data. But the psychology of using a piece of plastic for daily living completely removes the friction of purchase. When you use cash or a debit card, you experience an immediate depletion of resources. You feel the loss.
Right. It physically hurts to hand over cash or watch your checking account balance instantly drop on your phone.
Exactly. But a credit card defers that pain to the future, which is exactly how people accidentally drift onto the bad debt treadmill. So to resolve the contradiction, you have to satisfy the algorithm without exposing yourself to the psychological trap.
So how do we do that?
The most efficient way to apply this Greenbridge principle is to isolate a single, fixed, recurring expense, say, a $10 monthly streaming subscription, or your electric bill.
Okay.
You put that single charge on the credit card, you set it to auto-pay the full statement balance from your checking account every single month, and then you literally put the physical credit card in a drawer.
Oh, I see. So you never even carry the plastic with you.
Yeah.
You use cash or debit for groceries, dining out, daily life, so you maintain that psychological friction and avoid overspending.
Right.
Meanwhile, in the background, the streaming subscription is automatically generating the perfect low utilization data points that the algorithm demands. You're feeding the machine exactly what it wants without actually playing its psychological game.
That is the essence of hacking the system. You establish the baseline reputation entirely on autopilot.
Okay, so let's fast forward a bit. You've executed this strategy perfectly. You've kept your utilization low, your history is long, and you are staring at a flawless 800 personal credit score.
Living the dream.
Right. And you decide it's time to use some of that good debt to start a business. You set up your LLC. The logic would dictate that you just slide that pristine personal score over to the business side and start taking out corporate loans.
You would think so.
Yeah, but the Greenbridge materials hit us with what they call the entrepreneur's dilemma.
Yes. The primary directive in the materials regarding corporate structure is the absolute separation of business and personal credit. They operate in parallel universes.
Right.
The core advice is to never mingle the funds, because the entire purpose of forming an LLC or a corporation is to create a legal shield. If the business fails, that shield is supposed to protect your personal assets, your home, and your personal credit score from the fallout.
Which is the ideal theory. It's like you're wearing two completely different hats. When you are operating the business, you wear the business hat, and your personal finances are completely insulated.
Right.
But the presentation admits a really brutal reality check. It says that despite this rule, during difficult economic conditions or when a business is brand new, your personal credit, quote, may still hold weight.
Yep.
This feels like the ultimate bait and switch for a new founder. I mean, why go through the trouble of separating them if the bank is just going to look at your personal score anyway?
Because an LLC is really just a piece of paper. It is a legal fiction. When a business is brand new, it has no revenue history, no vendor payment data, and zero corporate credit profile.
Okay.
To an underwriting algorithm, lending money to a day-old LLC is mathematically indistinguishable from throwing cash into a fire.
Wow.
Yeah. The institution requires a bridge of trust, and the only established trust you have is your personal financial reputation.
So they demand a personal guarantee. They are essentially saying, we know the LLC has no money, so we are going to underwrite this loan based on the fact that you, the human being, will personally pay us back if the business goes under.
Exactly.
They are intentionally piercing that corporate shield you just built.
They're using your personal score as the ultimate backstop.
Yeah.
And the danger here is that if you don't realize how this mechanism works, you can destroy your personal 800 score simply by maxing out credit lines to keep a struggling business afloat.
Right.
The strategy implied by the Greenbridge separation rule is that the personal guarantee should only ever be a temporary umbilical cord.
So how do you cut that cord?
By aggressively building standalone corporate credit from day one, you open trade accounts with suppliers in the business's name. You ensure the business pays its own invoices directly from a business checking account. You build a distinct data profile with the commercial credit bureaus, which are entirely separate from the consumer bureaus. The goal is to reach a critical mass where the business's own cash flow and credit history are strong enough that banks no longer require your personal signature as a backstop. But, navigating that transition period requires intense discipline.
Discipline is great, but let's talk about the messy reality of just being human.
Yeah, life happens.
Exactly. Medical emergencies wipe out savings, recessions trigger sudden layoffs, businesses fail. If you get caught in a negative spiral and your score crashes from an 800 down to a 550, all those doors we've been talking about just slam shut.
They really do.
The Greenbridge presentation does dedicate a section to course correction and credit repair, though.
Right. And the mechanics of credit repair require understanding how the data brokers actually function. The materials point to the three major bureaus: Equifax, Experian, and TransUnion. And people need to realize these are not government agencies ensuring fairness. They are private, for-profit data aggregation companies. They sweep up billions of data points from lenders, courts, and utility companies and attempt to match them to your identity.
And because it is this massive automated sweep, the presentation highlights that finding and disputing mistakes is a huge part of repair. It isn't just about paying off what you owe. It's almost about, auditing their algorithm.
Absolutely. The matching algorithms are notoriously flawed. A similar name, a typo in a social security number, or a lender simply failing to update a paid-off account can result in severe derogatory marks on your file.
Wow.
So the mechanical process of repair is acquiring all three reports, because a lender might report to TransUnion but not Experian initiating formal disputes for any discrepancy. By law, if the bureau cannot verify the negative data point with the original creditor within a specific time frame, they must delete it from your file.
I mean, that sounds like a tedious bureaucratic nightmare.
Oh, it is.
Which explains why there is a massive industry of credit repair companies promising to just wave a magic wand and erase your bad history for a fee. When I hear credit repair, my mind instantly goes to late-night infomercials, the guys saying they can settle your debt for pennies on the dollar.
Oh, definitely.
Is there a magic wand here, or is it literally just rolling up your sleeves?
Your skepticism is completely valid. The warning in the materials is really necessary because of the mechanics of how debt settlement actually works behind the scenes.
Okay.
While there are legitimate credit counselors who can help negotiate interest rates, many of the aggressive settlement companies operate on a highly destructive model. They will instruct you to stop paying your creditors entirely and instead pay a monthly fee into an escrow account controlled by the settlement company.
Wait, they tell you to intentionally default on your existing accounts?
Yes, because their leverage in negotiating a lower payoff amount relies on the creditor believing you are completely insolvent.
Oh my.
Right. The creditor won't settle a $10,000 debt for $4,000 if you're still making minimum payments. They have to believe they're going to get absolutely nothing. So the settlement company literally forces your accounts into charge-off status.
Which completely vaporizes whatever is left of your credit score. You might settle the debt eventually, but the algorithms record months of severe delinquencies and charge-offs that remain on your file for up to 7 years.
Exactly.
It is a total scorched earth tactic.
Which is why the source material insists that true credit repair is fundamentally unglamorous. It's the steady, methodical work of auditing the bureaus for clerical errors, pausing any new credit inquiries, and establishing an unbroken chain of on-time payments. There are no shortcuts to rebuilding algorithmic trust. It is just a slow, deliberate process of proving your behavioral reliability all over again.
It always comes back to the algorithm's demand for behavioral data. Looking at the entirety of this Greenbridge presentation, the picture that emerges is incredibly clear. Your credit score is not a reflection of your inherent worth. It is simply the output of a mathematical formula designed to measure risk. You can fall into the bad debt treadmill if you treat credit like extra income.
Right.
You can use good debt to scale your wealth if you understand leverage and the necessity of the personal guarantee. And you can repair the damage if you're willing to navigate the bureaucracy of the three bureaus. It is a system, and systems can be mastered.
They absolutely can be. But, as we look at the length to which we have to go to satisfy these algorithms, like putting a $10 subscription on autopay just to generate the correct data points, or meticulously managing our utilization ratios, it raises a really fundamental question about the system itself.
Oh, what's the question?
We spent this entire discussion treating this three-digit number as an infallible mirror of your reliability and your character. It dictates your job, your home, your business. But as technology evolves, we're moving toward a world of alternative data. What happens when your financial reputation is calculated not just by your loan history, but by your digital footprint, your daily habits, or even the things you subscribe to,
Oh, wow.
right? As you look at your credit score today, ask yourself, if achieving a perfect score requires you to actively game the metrics by artificially engineering your spending habits to please a predictive model, is the credit score actually measuring your financial responsibility, or is it just measuring your ability to play the bank's game?